Welcome to the Wealth Twin Show. Today we got a fun one. Nadia and I are going to talk about if we started investing in 2026, what would we do? So, with that, Nadia, tell me, if you started investing in 2026, what would you do?
Well, one thing, if you're just starting to invest in 2026, right, you have to take into account your age. I would invest very differently if I was like my teen who's about to start investing versus someone who's in their 40s and starting to invest for the first time. If I was in my teens and I just started investing, I would be as aggressive as possible. I would go for a full portfolio of stocks. I would make sure I would buy stuff that I know was a company that I used to using. I would make sure I would go after companies that I use in my own life and start investing in that, especially if they allow you to do fractional shares, right? But if you're older and you have more responsibilities, let's say you're in your 30s and 40s and you're really looking to build wealth, but you know you don't have as much time on your side as maybe a teenager or somebody in their 20s would be, you cannot be as aggressive, right? So, what I would do there is I would split my portfolio in a way that will give me some risks that I can take on. And then put other stuff in lower risk securities. And what do I mean by that? I want to be able to protect the money that I'm investing at one point, which is going to be the majority of my portfolio. But I also want to be able to take risks with a portion of my money so I can help with growth, right? Because what I want to do if I'm starting at those years in my 30s and 40s, I want to make sure that the money I'm putting in is going to be protected so it can help me last longer in the market. But I also want to put some growth in there so I can see more gains on the money that I'm investing. So, what do you think, Nicole? How would you start investing?
Well, I mean, I like the way you split it off between different groups, but I still think no matter how old you are, right, and no matter how long you've been investing, you really have to stick with some fundamental principles, right? So for me, if I started investing in 2026, the first thing I'd be investing in is my job retirement accounts, right? Like the 401k, 403b, especially if you have a match. Why? Because I know it sounds typical, but it is free money. So the first thing I'll be concentrating on is making sure I was in my retirement accounts. Then I would see if I was actually eligible, depending on how much money I made, right? And where my money was coming from, if I can participate in a Roth IRA. Because that way I can actually put in money that I already pay taxes on, and then that money can grow tax free. Okay, so those are the first things I would do. The next thing I would do outside of the retirement accounts and also the IRA, I would look to see if the job I was in or the healthcare I was in actually avoided me to have an HSA account. So that's a health savings account. I like this account even though most people think of it as a way to like pay for medical expenses. You can actually invest in this account. So that right there is another way for me to actually use my money as a tool to actually grow, right? So those are the first things I would do. After that, I would say I agree with you, depending on the age, how aggressive you should be. But I like to follow the rule that Warren Buffett says. When it comes to investing, the first thing I want to do is not lose money. So for me, if I want to make sure I'm not losing money and give myself the best chance of making money, I want to be as broad as possible when it comes to my investing style. So with that, I'm talking about index funds, passively managed ETFs, because I'm going to look for the ones that, when I say broad, give me a little bit of exposure to different sectors that I can invest in, but not really put all my money in one sector. So, for example, I know AI is so big right now, everybody wants a piece of it, but that doesn't mean I need to put a large chunk of my money into it. But I can have some exposure to AI so that I can actually participate in some of that growth that's happening in there.
All right. Well, I will tell you this. I know a lot of people won't like this, but the reason why I didn't put investing in retirement accounts first when you're starting to invest is because I think when it comes to your retirement accounts, a lot of the times your job is going to have a limited amount of things that you can invest in, right? And most likely, those names of those investments are going to be confusing to you. And when you go into your company's retirement plans and you try to ask someone about it, it's not many people that you can actually ask questions about who can actually give you a detailed explanation of what you're investing in. So you're going to probably get the you're going to get the you're going to get information about the funds that are going to be in that retirement account, but it's not going to really help you if you're a beginner investor. When I'm thinking about if I was just starting in 2026, you should start investing on your own in a brokerage account so that you can start getting some guidance from the customer service representatives that are at that thing. Now, the reason why I say this is because of this. when you're starting out, a lot of the things that stops people from investing is the overwhelming amount of information that's available and a lot of the jargon. And what I mean by jargon is the words that are used in investing, right? So, if you need someone to ask questions to, you can go on YouTube, you can watch the Wealth Twins, you can watch other channels, and we do have resources for you to download to help you get over that hump of learning new terms because it's like learning a new language because you're learning a new skill, right? But if you're starting to invest your money and you want to start with small amounts of money, the best place to do that is in a brokerage account. One, you can start investing with as little as $1 or $5, especially when you want to start investing in index funds. I don't think that's possible in a lot of retirement accounts, right? Two, you're also able to ask questions to the customer service representatives at the brokers firms that we kind of try to recommend on this station or on this channel, right? We're looking at Charles Schwab, we're looking at Fidelity, we're looking at Vanguard. We don't work for any of these, but these are full service brokers that have live customer service that you can contact, speak to them. They're in the US most of the time, and you can ask them questions. Now, when it comes to actually booking your trade, they will charge you a fee. But if you book the trade yourself, you won't get charged a fee. And when you're investing with these platforms, there is no fee when you're starting to invest. That's why I think if you're starting to invest, not starting directly into your brokerage accounts, especially if your company does not provide a match, might be a better alternative for you so you can get your feet wet a little bit and then jump into those retirement accounts.
Okay, what's funny is that, guys, if you can see, we are twins,
Yep.
but we're not thinking the same. So I was over here writing my notes based on what Nadia was saying. So there's 2 points. The very reason I said to get into your retirement accounts is because of the free money, right?
Yeah.
Yes, I totally agree with Nadia that you're going to have a limited amount of funds that you can invest in, and you're going to be paying a lot of hidden fees with those accounts, right? So they're not the best when you're trying to maximize your money. But with the free money that comes in, this is why you should be in them. Now, when it comes to a brokerage account, I totally agree with Nadia. I did not say it when I first had my chance to speak, but you definitely have to have a brokerage account that you're investing in, but not because you can invest with a little bit of money and also not because you have guidance. I'm going to break those 2 points down. The reason why I say you need to be in a brokerage account, and I agree that everyone should be in one, is because it's a bridge account. And it allows you to use your money in a taxable brokerage account so that you can actually grow your money in the stock market, but you also can use it as a supercharged savings account and use it as another pot of money that if you had something that's a big expense or a big purchase or something great that you want to actually pay for, you don't actually have to tap into your retirement accounts, because if you tap into your retirement accounts too early, that is a big penalty and it's also just bad. It's not something you should do if you can avoid it. And one way to avoid it is to create a bridge account, which is your brokerage account. Another bridge account could be a high yield savings account, but when it comes to the advantage of a high yield savings account versus a brokerage account and the amount of money that can compound with you actually being able to invest in a brokerage account, it really is not apples to apples. The brokerage account actually, in my opinion, beats it. Okay. So that's the reason why you should be in a brokerage account when it comes to that. Now, when it comes to guidance, this is where I totally disagree with Nadia. No one's going to care about your money more than you, but they're going to try to get their hands on your money. Okay. So the guidance and the customer service, great. But I feel they're going to push their products and push their services on you. And you cannot delegate the responsibility of the decision making to someone who works in the firm. Okay. It could be a conflict of interest, but it also can be that it's your money, it's your savings, it's your life. You should not delegate that responsibility. And these big houses that we're talking about, these big brokerage companies, they also have financial advisors there. I don't care if it's financial advisors in that company or outside of it. Again, delegating all that responsibility to someone else and not having any type of decision making responsibility for yourself is never a good thing. So, yes, they can give you guidance on how to actually manage their platform and actually navigate their platform, but I will not suggest you using them as your North Star when it comes to learning how to invest. That is your responsibility.
No, I would agree. I say this because one, if you're learning how to invest and depending on how much money you have to invest, once you go into those brokerage accounts, you're going to start getting some phone calls from people who will happily help you manage your money, right? But if you're just starting out and you want to get your feet wet, brokerage accounts are a good place to start. Now, I won't sit here and believe me, I'm not telling you not to go into your retirement accounts, right? One of the reasons why Nicole and I were able to retire at an early age or in our 30s was because we invested early on in our job's retirement accounts. But understand, our job had a match. Our job gave a lot of incentives to start investing in your retirement accounts very early, and they had relatively good selections that we could pick from, right? So if you have that at your job, especially if you're in your 30s and your 40s or older, you should definitely be investing in those retirement accounts sooner rather than later. But I'm thinking of those are long-term savings, right? But they also help you with tax benefits, right? But you should also be investing, like Nicole said, in a brokerage account. And you need to understand what you're doing with your money. Do not delegate it. It's like learning how to drive versus being driven all over the place. You know how much more control you have, especially when it comes to your money. Just like you have more control of your destination and you're paying a lot less in fees because it's a lot less to pay for gas in your car than it is to pay someone to drive you around. So I hope that made sense to you so you understand you have the ability to learn it on your own. You should be doing it on your own. And then on occasion, if you want somebody to manage your money for you and do it that way, you can. But at the end of the day, your responsibility is to yourself, and you need to learn how to invest so that you can know when someone's making the right decision for you or you're making the right decision for yourself.
Okay, now that we spoke about it, we're talking about, guys, if you're trying to keep up, we're talking about retirement accounts, HSA, broad-based ETFs and index funds, and also
Yep.
brokerage account. Now, outside of that, for 2026, and I'm just looking at what's going on in the environment, the economy, and things like that. One thing I'm going to look into more because it has served me well in the past are Treasury I bonds, right? These are inflation adjusted fixed income bonds, savings bonds, and they go up in terms of the interest that they pay based on what's going on with inflation. So at one point, these I bonds were paying over 9% in interest. And this is basically, you're talking about risk free 9% interest on your money. So I'm going to keep a lookout at those to see the inflation is climbing. And I believe these might be a good play. So that's something, if I was looking to invest in 2026, that is another play. It's not something that's going to grow your money, but it's going to give you a good return on your money and also save that pot of money because the first thing, remember, is to make sure that you don't lose the money.
Now, Nicole, I will play devil's advocate for a little bit. And I know people might be saying, but twins, why didn't you say invest in Bitcoin or some swing trading or anything like that? And I will tell you why. Because Nicole and I both are doing relatively well. Let's put it that way, right? If you have money come to you fast and you have all these things that you have to chase here, do this, it's nerve wracking. And at the end of the day, you're most likely going to lose more money than you're going to make. Who has time for that? You're looking at two people who have built long term wealth. We did it in a sustainable way, and we did not need to do swing trading. We did not need to do day trading, and we did not need to invest in Bitcoin. Now, you can do that, but what I like to tell my students is have a core and explore portfolio. Your core securities that you're investing in should be securities that are relatively low risk, that you can invest in on a consistent basis, and they're growing for you on a consistent basis. And most likely, these are funds that follow the S&P 500 or other things, right? These are safer securities, right? Then you have your explore. These are the things that you can put a little money in that you can risk. Think of it like not gambling, but it's speculating, right? And you're saying, okay, if these pop off, that's great. If they don't, it's not going to make or break me, right? You can do that with about 10% of the money you want to put in. But that should not be the bulk of your portfolio. I'm telling you now, most people who do that day trading, that swing trading, or invest in very volatile securities don't stay in it long. And the only way you can make money in that is if you're selling or you're selling to someone who's going to buy it for more than you paid for, right? But when you're investing in the way that we do, you're looking to get money from two ways. You can get money from dividends, which is passive income in the stock market, and you can get money from the growth of your securities. But what you're not doing is putting a huge risk on the amount of money that you're investing. So that pot of money has a longer time to stay in the market and compound for you and grow for you without you doing much work on your end, right? So I know people are flashing around this trendy investing thing, but if you speak to most people who have money or the amount of money that you want, I guarantee you they're not doing what a lot of people are pushing out there with their own money.
Yeah, I think this is a good point to make is that the title of this is called What We Would Invest In, right? Not trading. There's a big difference
Yep.
between trading and investing. When you're trading, you're trying to be active. You're looking at the markets every day. You're trying to make some type of arbitrage between what Nadia said, what you bought it for and what you're willing to sell it for, right? When investing, that's not the game we're playing. We're playing a longer game where we're trying to actually buy into companies or investments that we feel that can grow in value over time. Okay, so this is what we're looking at. We're looking at long-term horizons. Now, this might not sound sexy, right? And it might sound like we're telling you the vitamin versus giving you the pill because everybody wants a six pack overnight. But everyone knows, right, that the six pack is made in the kitchen. You have to clean up your diet, you have to go to the gym. In the long term, you'll end up getting a six pack. It's the same thing when it comes to building wealth and making money investing, not by trading. Yes, one might seem sexier, but guess what? Odds are not many people win. Okay, so that's why Nadia and I like to do more. Another thing we like to do, we like to diversify. Not only do we invest in the stock market, we also invest in real estate, we also invest in businesses, and we also invest in ourselves. That way, no matter what happens in the economy, no matter what is hot or not, we have some way to get some income coming in and making sure that we continue to make sure our wealth grows. If you're playing just one game, if you're just focusing on one area of that game, you're missing out on so many opportunities. And if you're looking at a particular stock, which I think is a little bit of a gamble, if you're looking at a particular stock, you have to understand there's an opportunity cost because you missed out on so many other stocks that you could not have paid attention to. There's just too many companies out there. So when you try to play the stock game, understand that you picked one, but there was 10 that probably outperformed the stock that you actually bought. And you don't know and you can't figure that out because it's just incapable for a person who is actually has a life to be able to keep up with all of them.
Yeah, I think you got to ask yourself, do I want to try to make 10,000 in a week, or do I want the higher possibility of making $1 million in 10 years? I know which route I took. I know it's more consistent. I know more people have become millionaires doing that. So that's the route I took. Yeah, there's some people who can make it at 10 million. I'm not built like that. I don't like the stress of it. I like consistent and I don't like risk, right?
Not just that, it's a game you don't have to play
You
in
don't
order
have
to
to play
win.
this. What? Why play that game? It's like playing football all the time and going for Hail Mary passes. Why? First down exists. Keep making first downs till you get to the end goal. If I'm using the right words, because I don't watch football like that. But there are many ways to skin this cat. Understand what kind of person you are and which way suits you the best, right? There's so much information out there. You need to find out and truly ask yourself, what would I like to do? Do I want to try to do this already? And can I deal with the uncertainty of it? And I like the excitement, I like the risk, or I don't want to take as much risk with my money. I want a little more certainty. Like, and everybody knows in the stock market, no one can guarantee you zero risk, right? But there are products that come closer to that in reality so that you can have a little more consistency when it comes to growing your money. So you just got to ask yourself. But I think Nicole also made a good point. Investing in yourself is something you should definitely be doing in 2026. If you guys hear the news right now of how AI is going to change our lives, you should be investing in yourself to increase your skills. Your job could possibly be taken by AI or taken from you by someone who has learned AI and has learned how to do your job more efficiently. So that's what you should also be thinking, okay? Not just investing in outside investments, but invest in yourself because that's one of the best investments you can ever make.
Yeah, I mean, at the end of the day, when Nadia and I are investing, which we will be doing in 2026,
We continuously invest.
yeah, we continuously invest. And also, we try to stack the odds in our favor.
Yep.
And we're trying to stay in the game. If we do anything that could be a home run, it could be a huge strikeout as well. Anything that forces us to get out of the game is not something we're willing to do because it's too big of a loss and it's too big of a risk. So we do take calculated risks, but we try to make sure that one, we protect the money that we have, we grow the money that we have, and we stay in it so that we're able to see another day. Those are the things that we're focused on. And those are the things that we will continue to focus on because they have worked. And they not have only have worked for us, but for many people. So if this is the way that you want to learn how to invest and you believe in what we're saying, and you're saying, you know what? I do want to have time on my side. I want to have compounding work for me. I don't want to be trading and having to sit at a screen and listen to all the news and take out that time out of my day and out of my life that I could be using for something else. But I want to find a way that's sustainable and actually allows me to grow my wealth that will show up big time and pay dividends years to come. Then I suggest check out our newsletter. It's called the WealthPack. You can look at the description below, right? Or you can even download our 25 must know investing terms if you feel the first thing you need to do is actually learn the language of investing, because we did use some terms that might have seemed a little too, complicated. So if that's you, that will also be down in the description box below.
Yep. And guys, understand, Nicole and I are almost 50 years old and we don't have wrinkles. It's because we don't sit up here trying to play games with our money. We make sure we know what it's doing and why it's doing it, and it's going to be there for us.
And I can't believe you told our age, but on top of that, it's also because I drink water and mind my business.
Exactly. All right. And guys, hope you enjoyed this video. Make sure you like it, share it, and subscribe to the channel, because we heard at least 60% of you are watching our videos and you haven't subscribed. And you may not know that you haven't subscribed yet. So make sure you subscribe to the channel. It helps us and it helps us reach more people. So we'll see you in the next one.